Welcome to Stony Finance Lab channel.
Hello, my name is Steven,
My name is Connor.
And my name is Jerry Wang.
and our topic is financial strategies for college and beyond. These are the terminology that will be used in the presentation, and the agenda is as shown on the right. The people who we see benefiting the most from this presentation are incoming college freshmen who want to learn how to be financially stable. What they should make a goal is to cover all the necessities while also investing the remaining money long-term to see how investing can yield great results. Some ways of achieving this goal are through Roth IRAs, ETFs, bonds, REITs, and cryptocurrency. The budgeting strategy that should be focused on is the 50-40-10 rule. This strategy focuses on allocating the funds appropriately in order to build the habit of how to spend money wisely. 50% of income is prioritized for things like rent, bills, and loan payments, while 40% of income will be used to grow your money through interest, properties, stocks, decrease any debts, or save up a retirement plan or emergency fund. The remaining 10% of income will go to luxury objects that you can make do without, such as the latest PlayStation or iPhone model. To put it into perspective, we have a case where 3 people start off in a similar situation, but choose differently how they spend their money for a year. After their expenses, each person has $600 in their budget, and the rate of return is 1.39%. The first does not invest, but spends everything on luxury goods. The second will put 80% of his budget into investments, and the third will invest everything he has left in the budget. The slope is the accumulated portfolio value for each person, and we see just how significant knowing how to budget is. It not only gives you a sense of how your money is used, but also a general sense of how much it can grow in different scenarios.
Our recommended investment strategy is to passively invest for the long term over the course of 4 years or until retirement. We can do this by dollar cost averaging into a diversified portfolio. We're going to use the entrance strategy of dollar cost averaging to ensure that we can reduce the impact of market volatility. Dollar cost averaging divides the total amount of money to be invested across periodic purchases of assets. So say you have $800 a month to invest, you'd want to invest $200 each week across your portfolio to make sure that you are buying regardless of the asset price. We're also going to want to buy and hold our assets. This means that we will not be selling our assets even if the price fluctuates. We will want to hold the assets anywhere between 4 and 10 years or until a specific investment goal is reached. We also want to diversify our portfolio into multiple different assets such as equity ETFs, bond ETFs, REITs, and cryptocurrencies to gain exposure to different markets that may outperform one another. Lastly, we want to exit our investments once we have reached a specific time period of investment of our investment goal. And we also can set stop loss commands, which will sell our assets immediately once they decline down to a certain point. Now we will go over the types of investment vehicles we recommend using. First, we will put our assets into a Roth IRA. This investment account allows for withdrawals on a tax-free basis as long as certain conditions are met. The money put into the account are considered after-tax dollars, which means that you will pay tax going into the account, but withdrawals are tax-free coming out. We recommend utilizing a Roth IRA if you anticipate being in a higher tax bracket than you currently are in for the long-term future. Next, we want to start figuring out which investments we want to add to our Roth IRA. We should certainly buy ETFs or exchange-traded funds, which are pooled investment securities that track a particular index, sector, or other asset. ETFs are traded on the stock exchange and can be bought just like a stock can. There are also maintenance fees associated with ETFs, so we want to aim for ones that have lower fees. Next, we have REITs, or real estate investment trusts. These are also similar to ETFs and stocks as they are traded on the stock exchange during trading hours. However, they are individual shares of a company that solely owns, operates, or finances real estate. Investors can earn dividends without having to deal with the hassle of buying, managing, and financing any property themselves. These assets invest in most property types, such as apartment buildings, cell towers, data centers, and other properties. Next up, we have bonds. So these are fixed income instruments that represent a loan made by an investor to a borrower. They can be used by companies and governments to finance projects and operations. The owners of the bond are referred to as the bondholders, and they can be pooled into an ETF which trades on the stock market. The bond details include the end date when the principal of the loan is due to be paid to the debt holder. And it is important to note that bonds are inversely correlated with interest rates, which means when interest rates rise, bond prices fall, and vice versa. And lastly, we have cryptocurrencies, which are digital or virtual currencies that are secured by cryptography, which makes it nearly impossible to counterfeit or double spend. Cryptocurrencies are built on decentralized networks based upon blockchain technology. The blockchain utilizes a distributed public ledger enforced by a network of computers. And theoretically, cryptocurrencies should be immune to government interference, but as history has shown, that could change in the future. To purchase cryptocurrency, you will need a crypto brokerage account found on platforms such as Robinhood or Coinbase. Here's a pie chart of our portfolio we will create to hit our investment goal. We recommend investing 50% of the available investment capital into equity ETFs to capture the high stock market returns that history has proven to be relatively consistent. Next, we want to invest 25% of our available capital into REITs in order to own real estate, which is also consistently providing us with high returns. Next, we want to invest 15% in bonds to become exposed to fixed income securities, which will give us a reliable return. And lastly, we want to invest the remaining 10% into cryptocurrency to potentially capture the radical gains that we have seen in the past since its inception. So now let's take a look at the possible return and risk associated with the top assets within each class. First, we will analyze the Vanguard S&P 500 ETF. This ETF closely tracks the S&P 500, has a low maintenance fee, and averages about 15% returns per year since its inception. This fund has consistently beat out the overall market, which returns about 10% a year. And if you invest $2,880 and contribute $240 monthly for the next 4 years, with a 15% return, you will have about $20,000. If you start the strategy at the age of 18 and contribute the same amount consistently, by the age of 60, you will have about $11.5 million. Now let's take a look at the risks associated with the fund. A large market crash or correction can lead to a drop in the ETF value due to investors pulling out of the fund. And we can see that this fund has an alpha of negative 0.04, which means that over the past year, it has not shown an ability to beat the market. Its beta is 1, which means it is exactly as volatile as the market. And lastly, it has a Sharpe ratio of 0.97, which means that it's certainly beating the market in terms of excess risk return per unit of risk. Next up, we have the Vanguard Real Estate Index Fund ETF, which tracks the real estate index. This fund is filled with stocks issued by actual REITs that invest in office buildings, hotels, and other property. This fund has averaged an 8.96 return over the past 10 years, which is a decent return in general. So if you invest $1,440 today, which is equal to 25% of the available investment capital, and contribute just $120 a month for the next 4 years, with an 8.96% return, you will have almost $9,000. If you invest $1,440 at the age of 18 and contribute $120 a month until the age of 60, you will have about $700,000. Now, like every other investment, there is risk associated with the fund. It's important to note that a rise in interest rates can cause real estate prices to fall. We can see that this fund has an alpha of 1.74, which means it is outperforming the market, the category, and the index that it is measured against. It also has a beta of 0.9, which means that it is less volatile than the overall market, and a Sharpe ratio of 0.55, which means that it has a decent excess return per unit of risk.
And when it comes to bonds, it is considered one of the safest investments. It is almost guaranteed that you will get an average return of 3.01% in return. In other words, the risk of losing money with bonds is low, but also low in profits. If you invest $864 and contribute $72 for the next 4 years at a 3.01% return rate, you will have $4,600,000 in return. However, if you invest the same amount at an age of 18 and contribute the same amount for the next 42 years, you will have a $75,000 portfolio at the end of your 42nd years. Overall, bonds are relatively safe compared to the stocks and other investments vehicle. However, during bad economic conditions, shares will drop and will cause a risk of losing returns. Cryptocurrency is another popular investment recently, especially during the pandemic. There have been many different cryptocurrencies throughout the years, and Bitcoin is one of the original ones. They use peer-to-peer technology to facilitate payments and has fixed supplies of 21 million coins. From the past 10 years, Bitcoin has made an average of 148% in average return. If we were to invest $576 today and contribute $48 a month with 99.99% in return, then the value will be over $53 million. If you were to start as early as 18 years old and continue investing into Bitcoin at to the age of 60, your average return will be astronomical. However, realistically speaking, it is very unlikely to achieve that 99.99% average return, and cryptocurrencies are very volatile. And some of the mistakes to avoid are active trading, because study has shown that the more you trade, the more money you lose. The more often you trade, the higher your expense will be because of the transaction cost. Another mistake to avoid is to never panic sell. Be rational rather than emotional. See the market crash as an opportunity to enter the market. Be greedy when others are fearful. Remember that the market will always bounce back and you don't lose money until you sell the stocks. Having a diversified portfolio is also another safety mechanism that will prevent you from losing a large chunk of money at the same time. Do your research and play for the long run. Learn from your mistakes and use that as a lesson for the future. And just to summarize everything, right? These are some of the terms that we have went over along with the different strategies. Roth IRA is an investment account that allows for withdrawals on a tax-free basis if certain conditions are satisfied. ETF, type of pooled investment security that tracks a particular index, sector, stock, bond, and these can be actively or passively managed. Bonds, fixed income instruments that represents a loan made by an investor to a borrower. And rights, a company that owns, operates, or finances income-generating real estate. Cryptocurrency, digital or virtual currency that is secured by cryptography, which makes it nearly impossible to counterfeit or double spend. And finally, this will be the end of our presentation, and I really do hope that all of you guys have learned something. Me, Connor, and Steven has really put in the effort in making this video, and we really do hope that you guys learn something and use this video as a start for your investment journey. Thank you.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.